Good morning or good day to you, my friends. We are glad you are here. You are well, right? It is important to us that you are okay. Give us a comment to let us know the value the other videos have provided to you. This is our last video on the principles of insurance. The last, but not the least of these principles, is the principle of contribution. How is the principle of contribution defined? The principle of contribution is a concept commonly used in insurance and refers to the idea that multiple insurance policies covering the same loss or damage should each pay a proportionate amount towards the claim. Under this principle, if multiple insurance policies cover the same loss, each policy should pay only their proportionate share of the loss. The total amount paid out to the insured should not exceed the amount of the loss. This ensures that the insured is not overcompensated for their loss and that each insurer bears a fair share of the liability. For example, if a car is damaged in an accident and the owner has two insurance policies, one with coverage of $10,000 and another with coverage of $5,000, the principle of contribution would require that each policy pay a proportionate amount towards the total claim. Assuming the total cost of repairs is $12,000, the first policy would pay 5/8 or $7,500, and the second policy would pay 3/8 or $4,500. This ensures that the total payout does not exceed the actual cost of repairs and that each policy pays only their proportionate share. To determine the share of each insurer, the total amount of the loss will be calculated and then divided between the two policies based on the proportion of the total coverage provided by each policy. The policy with a higher coverage limit will be responsible for a larger share of the loss, while the policy with a lower coverage limit will contribute a smaller share. The application of the principle of contribution ensures that the insured party does not receive more compensation than the actual loss incurred, as the total payout from both policies cannot exceed the total amount of the loss. It also prevents the insured party from benefiting from multiple insurance policies covering the same risk. How contribution is applied in insurance. The principle of contribution is applied in insurance when an insured party has more than one insurance policy covering the same risk or loss. When multiple insurance policies cover the same risk, the principle of contribution requires that each insurer pays their proportionate share of the loss or damage. The application of the principle of contribution involves the following steps. Identify the existence of multiple insurance policies covering the same risk or loss. Determine the extent of coverage under each policy and the contribution of each policy towards the total coverage. Calculate the total amount of loss or damage. Divide the total amount of loss or damage between the insurers based on the proportion of the total coverage provided by each policy. Each insurer pays their proportionate share of the loss or damage up to the limit of their policy coverage. The application of the principle of contribution ensures that each insurer shares the loss or damage proportionately, and the insured party is not overcompensated for the loss or damage. It also helps prevent fraud and misrepresentation, as an insured party cannot benefit from multiple policies covering the same risk. Importance of contribution principle in insurance. The principle of contribution is essential in insurance because it ensures that each insurer contributes their fair share towards a claim when multiple insurance policies cover the same risk or loss. The importance of the principle of contribution in insurance includes 1. Avoiding overcompensation. The principle of contribution prevents an insured party from receiving more compensation than the actual loss or damage incurred. Each insurer pays their proportionate share of the loss or damage, which ensures that the insured party is not overcompensated. 2. Preventing fraud. The principle of contribution helps prevent fraud and misrepresentation because an insured party cannot benefit from multiple policies covering the same risk or loss. It encourages insured parties to provide accurate information to insurers about their coverage to avoid fraudulent claims. 3. Encouraging fair competition. The principle of contribution promotes fair competition among insurers because it prevents one insurer from covering the entire cost of a claim when multiple policies cover the same risk. Each insurer shares the cost of the claim proportionately, which promotes fair competition and prevents one insurer from gaining an unfair advantage. 4. Saving costs. The principle of contribution helps to save costs for both insurers and insured parties because each insurer only pays their proportionate share of the claim, reducing the total payout amount. 5. Reducing ambiguity. The principle of contribution helps to reduce ambiguity and conflicts between insurers and insured parties because it provides a clear and straightforward method for determining the contribution of each insurer towards a claim. In summary, the principle of contribution is important in insurance because it promotes fairness, prevents overcompensation and fraud, encourages fair competition, saves costs, and reduces ambiguity. Contribution application in underinsurance. Underinsurance occurs when an individual or organization has an insurance policy that does not provide sufficient coverage to adequately protect against potential losses. This can have serious consequences for those who are underinsured, as they may find themselves financially vulnerable in the event of a major loss. However, there are several ways in which contribution applications can be used to address underinsurance. Contribution applications allow multiple insurers to share the risk associated with a single policy. This means that rather than relying on a single insurance provider to bear the full cost of a potential loss, multiple providers share the risk and contribute to the cost of the claim. This can be particularly useful in the case of underinsurance, as it allows individuals or organizations to obtain coverage from multiple providers and effectively increase the total amount of coverage available. For example, if an individual or organization has a policy with a limit of $500,000 but requires coverage of $1 million, they could potentially use a contribution application to obtain additional coverage from multiple insurers. In this scenario, two insurers could each provide $250,000 in coverage, effectively doubling the total amount of coverage available. In addition to increasing the total amount of coverage available, contribution applications can also help to reduce premiums and provide more favorable terms and conditions. This is because the risk associated with a single policy is spread among multiple insurers, which can lead to lower costs and more favorable terms. Overall, contribution applications can be an effective way to address underinsurance and provide individuals and organizations with the coverage they need to protect against potential losses. By allowing multiple insurers to share the risk associated with a single policy, contribution applications can help to increase the total amount of coverage available, reduce premiums, and provide more favorable terms and conditions. Factors hindering the application of the principle of contribution. While contribution can be an effective tool for mitigating the risk of underinsurance, there are several factors that can hinder its application. Here are some of the factors that may make it difficult to apply the principle of contribution. 1. Coordination challenges. Contribution requires coordination among multiple insurers, which can be challenging to achieve. Each insurer may have different terms and conditions and may be reluctant to participate in a contribution agreement due to concerns about liability, profitability, or reputational risk. 2. Regulatory issues. The contribution may be subject to regulatory constraints, which can vary depending on the jurisdiction. Some regulators may require insurers to follow specific rules when entering into contribution agreements, which can make the process more complicated and time-consuming. 3. Administrative complexity. The administrative requirements of implementing a contribution agreement can be complex and time-consuming. Insurers may need to agree on a common policy wording, decide on how to allocate premiums and claims, and determine how to communicate with policyholders. 4. Disputes among insurers. Disputes among insurers can arise regarding the allocation of premiums, claims, or losses. Disputes can also arise regarding the interpretation of policy wording, which can be difficult to resolve without the involvement of legal experts. 5. Limited availability. The contribution may not be available in all insurance markets or for all types of policies. Some insurers may be unwilling or unable to participate in a contribution agreement, particularly if they do not have the necessary expertise, financial resources, or risk appetite. Overall, while contribution can be a powerful tool for managing risk awareness, insurers can educate policyholders about the benefits of the contribution principle, including how it can help to reduce premiums, increase coverage, and provide more favorable terms and conditions. Policyholders can also educate themselves about the concept of contribution and how it can be applied to their specific insurance needs. 2. Clear communication. Insurers can communicate clearly with policyholders about the terms and conditions of their policies, including any contribution requirements. Policyholders can also communicate their needs and expectations to insurers and seek clarification if they have any questions or concerns. 3. Cooperation in claims handling. Insurers and policyholders can work together to handle claims in a timely and efficient manner, which can help to minimize losses and reduce costs. This may involve providing accurate information and documentation, cooperating with insurers' investigations, and resolving disputes in a constructive manner. 4. Collaboration in risk management. Insurers and policyholders can collaborate on risk management initiatives, such as loss prevention, safety training, and risk assessments. This can help to reduce the likelihood of claims and improve the overall risk profile of policyholders. 5. Advocacy for contribution. Insurers and policyholders can advocate for the use of contribution in the insurance industry by promoting the benefits of this approach to other stakeholders, such as regulators and industry associations. This can help to increase awareness and understanding of the contribution and encourage more insurers to adopt this approach. Overall, insurers and policyholders can work together to promote the use of contribution in the insurance industry by educating themselves and each other, communicating clearly, cooperating in claims handling and risk management, and advocating for this approach. By working together, insurers and policyholders can help to realize the benefits of the contribution principle and improve the overall resilience of the insurance industry. Other instances where the contribution principle is applied in insurance. The contribution principle, also known as the principle of indemnity, is a fundamental concept in insurance that governs how losses are shared among policyholders. In addition to its application in property and casualty insurance, the contribution principle is also used in various other types of insurance, including 1. Health insurance. Health insurance policies typically require policyholders to pay a portion of their medical expenses out of pocket, which is known as the deductible. Once the deductible is met, the insurance company begins to pay a portion of the remaining medical expenses. The contribution principle is applied in health insurance when policyholders pay their premiums, which are used to cover the cost of medical care for all insured individuals. 2. Life insurance. In life insurance, the contribution principle is applied by pooling the premiums of all policyholders to create a fund that can be used to pay death benefits to the beneficiaries of policyholders who die during the policy term. 3. Unemployment insurance. Unemployment insurance is a government-provided benefit that is designed to provide financial assistance to individuals who have lost their jobs. The contribution principle is applied in unemployment insurance by requiring employers to contribute a portion of their payroll taxes to a fund that is used to pay benefits to unemployed workers. 4. Social Security. Social Security is a government program that provides retirement, disability, and survivor benefits to eligible individuals. The contribution principle is applied in Social Security by requiring workers to pay Social Security taxes on their earnings, which are then used to fund the program. In all of these examples, the contribution principle is used to ensure that the costs of losses or benefits are shared among a group of individuals, rather than being borne by any one individual alone. Some instances where the principle of contribution is mentioned in insurance. The contribution principle is a fundamental concept in insurance that refers to the sharing of losses among multiple policyholders. Here are some instances where the contribution principle is mentioned in insurance. 1. Property and casualty insurance. In property and casualty insurance, the contribution principle is used to ensure that each policyholder pays a fair share of the cost of losses that are covered by the policy. For example, if two policyholders have a property insurance policy that covers damage caused by a storm, the insurance company will use the contribution principle to determine how much each policyholder should pay towards the cost of repairs. 2. Reinsurance. Reinsurance is a form of insurance that is purchased by insurance companies to protect against large losses. The contribution principle is used in reinsurance to determine how much each insurer should contribute to the reinsurance pool, which is used to pay claims when losses exceed a certain threshold. 3. Contribution clause. A contribution clause is a provision in an insurance policy that requires multiple insurers to contribute to the cost of a loss. For example, if a policyholder has multiple insurance policies that cover the same loss, the contribution clause will specify how much each insurer should pay towards the cost of the loss. 4. Pro rata contribution. Pro rata contribution is a method of sharing losses among multiple insurance policies that cover the same risk. Under this method, each insurer pays a proportionate share of the loss based on the amount of insurance that they have provided. For example, if two insurers have provided $50,000 and $100,000 of coverage, respectively, they will contribute to the loss in a 1-to-2 ratio. 5. Excess insurance. Excess insurance is a type of insurance that provides coverage for losses that exceed the amount of coverage provided by the primary insurance policy. The contribution principle is used in excess insurance to determine how much each insurer should pay towards the cost of the loss, based on the amount of coverage that they have provided. Lastly, let us talk about the coinsurance. Coinsurance is a concept used in insurance that refers to the sharing of risk between the insurer and the insured. It is commonly used in property and casualty insurance, where the policyholder shares the risk of a loss with the insurer by agreeing to maintain a certain level of insurance coverage on their property. Under coinsurance, the policyholder agrees to maintain a specified percentage of insurance coverage on their property, typically 80% or 90% of the property's actual cash value. If the policyholder fails to meet this requirement and experiences a loss, they will only be reimbursed for a proportionate amount of the loss based on the percentage of the property's value that was insured. For example, if a property is insured for only 50% of its actual cash value and experiences a loss of $100,000, the insurance company will only pay 50% of the loss, or $50,000, and the policyholder will be responsible for the remaining $50,000. Coinsurance is intended to encourage policyholders to insure their property at an adequate level and to share the risk of loss with the insurer. It can also help to keep insurance premiums more affordable by ensuring that policyholders maintain adequate coverage and do not underinsure their property. Coinsurance is typically found in property and casualty insurance policies, including homeowners insurance, commercial property insurance, and business interruption insurance. We are glad you have accompanied us through the 7 principles of insurance. Have you received any value from these and our other videos? Please let us know in the comments section below. Many people are watching our videos, which makes us very happy. As you watch, please take a sec and subscribe so that we become a family. Bye-bye for now. Let's meet in another video soon.